Now we're going to talk about Europe and the absolute train wreck that we're seeing take place, which I do find a bit fascinating that it's starting to resonate now with the ECB. But they had a special meeting. Nothing came from it, which is not surprising in the slightest. But again, you're starting to see some of those concerns. And a lot of that data is the big driver to it in general. So when you look at the survey expectations, ZEW for the aggregate, it was still negative 28, a bit better than it was last month. But there's where we continue to see things with industrial production getting worse again when you look at it from April, which we do think continues into May as well into June, with the trade balance getting a bit worse as labor costs continue to go up. When you look at year over year, the labor costs have gone from 1.9% to 3.2%. Germany is no different. Wholesale prices are up 1%, wholesale year over year, 22.9%, with more coming up. CPI still very high, still very strong, with the survey expectations weakening further in terms of what the expectations are going forward. So people are looking at the current situation, not as bad as estimates. The estimate was for the current situation was negative 31. It came in at negative 27. But expectations, so coming forward, based on everything that they're seeing in Germany, the survey expectations came in at negative 28 versus the estimate of negative 26. So again, you're seeing that pivot and things getting worse, which again is creating some of the underlying pressure points. Now, when we look at France, we had a bit of a step up in terms of inflation, which isn't surprising. They should see the least amount in terms of, other areas on who takes in what from the oil and natural gas side. But when you look at underlying pressure points, France is still an importer, and that's going to keep prices moving up. So again, these inflationary numbers is what is now driving the ECB into some sort of action. Italy industrial production bounced versus estimates. The estimates for negative 1.1 came in at 1.6. But when you start looking at CPI and some of the pressure, it's continuing to remain in place, which is where we're starting to see some softness in Italy. As we talked about, we're seeing that weakness as of May into June. So this is carrying April. So we do expect downward momentum on the industrial production and where we see some of these pressure points. So now the market expectation for July 2022 continues to be the rate change that they're going to increase rates. The effective rate for 2022 has now been moved up to 1.47%. So there is an expectation that they are going to increase rates. And you're starting to see this bifurcation in the countries themselves in terms of playing one bond against another as fears start to mount. We know what that looks like after 2011 and the European financial crisis, and how that can continue to lead to stress. We see them essentially heading headlong into a very similar situation while the ECB tries to raise rates. And when you look at a German tantrum, the rolling 6-month change in the German 10-year bond continues to move up. Now, obviously, when you factor in how insane inflation is, the real rates are still deeply negative, but you're getting an idea on the pressure to the upside. Now, this is all happening as the ECB staff continues to adjust their expectations for inflation and take it down for GDP growth. As you can see, they still have growth in 2022. We think that that is false and that they will not have growth in 2022 as inflation continues to remain white hot, and we don't see that dropping anytime. And I always love including the expectations as they have continuously gotten it wrong. And as you can see, there's always a view that it drops off fairly steeply, and we do not see that happening. And that's why when you look at the bond curve, like the bonds in general, you're seeing that shift up, but the flattening, which is why we do think that long duration bonds are going to also have that steepening effect as they fail to get in front of inflation, as economic growth expectations continue to diminish. They're better and off the lows, but still negative, and it's still expectations, which is why we think that this year is going to be sloppy. Now, the European Union versus Italy. So they view that it is different this time. The 10-year BTP versus bond spread has reached a crisis level, but the GDP-weighted euro area bond spread over swaps remains very much under control. So there's no broad-based fragmentation on that metric, but when you look at the underlying pieces, you're seeing that spread really start to widen out in terms of fear between what would be deemed as safety of the German bond versus the riskier asset in terms of Italy, Greece, and other. And that bifurcation is where I think you're starting to see the ECB get a bit more concerned, which is what I would assume some of their commentary was when they had the emergency meeting. I did not expect them to come out and raise rates magically, though they probably should have. But it was really, I think, talking more and more about what is happening in the underlying market. So, and especially when you start looking at the peripheral bond market, which is getting ugly. More than the level of bond yields, it's about the process. So the volatility is starting to pick back up and the liquidity is starting to deteriorate. And that's where you're starting to get these fears as rate hikes accelerate. You're starting to see the bigger pressure in Italy because they did issue the most QE, which is why we see some of the bigger pressure points coming into the Italian market, especially when we talk about industrial production, industrial activity, and where we see that heading into the next few months. Now, the market is front-loading monetary tightening. The average 10-year bond yield is up 250 basis points this year to levels not seen since before the quantitative easing was announced. One thing to keep in mind is again, the ECB is very late to this pivot, and why we see more pressure to the upside as the Fed raises rates, the UK raises rates, the rest of the world raises rates, the ECB and the BOJ are going to be forced to do something similar to help try to insulate and adjust. And that's going to put the Chinese PBOC in a very difficult spot because we have all of these rate rising. And again, you're going to see a lot of this additional pressure in China because realistically, as rates go up in the US, are you going to want to invest in the U.S. at a better yield or in a Chinese entity? And I think you're going to start to see some of these pressure points emerge. So Eurozone trade balance dropped like a rock, and this is where you're starting to get a lot of these pressure points when you look at import prices going up, exports slowing in terms of nominal trade. So the normalized index, when you think about the ZEW and the Centix, in terms of where is sentiment, where is consumption going to be, as consumption drops, as the consumer drops, that's going to, again, pull down PMI, pull down industrial activity, which is why we're fairly confident on our view that the Europe is already in a recession. Eurozone industrial production, excluding construction, remained elevated in some areas, but remember, this is for April, and May and June are very different months when you look at cost, when you look at pressure, and we see that, again, that dropping fairly quickly when we look at what global trade is doing. Now, to kind of round out where some of these different pieces are, the net trade was driven by inventories. So the net trade piece is a lot of inventories building up. You're not seeing a lot of things move. And as that happens, you're going to see exports slowing, imports starting to slow. But again, the drop is first. Exports drop. Imports are starting to drop. Remember, there's going to be that connection. So as inventories continue to build in terms of where that that GDP growth is, inventories will be a negative driver, and we do expect net trade to start to be a negative driver as consumption starts to get worse. It will hold okay, but we started to see the cracks, and we see that accelerating. Euro area supplier delivery times continue to be impactful in terms of increasing cost. And again, we don't see that adjusting anytime soon, as they are the furthest away. They were we do see supply chain issues. The U.S. has gotten a bit better, but we're seeing inventories be the key driver, which again is starting to insulate us, and you're going to start to see that build up in Europe as well. That could provide a little bit of a bump to GDP growth. But then when you think about overall trade and the projection going forward, there's a net drag on that, which is we're starting to see, especially as prices continue to go up. So that's what we have for you today. We're going to have more on the ECB, especially after on Europe, especially at the ECB meeting, and what are they going to do to try to pivot. And I think there's going to be a lot coming out that we're going to have to talk about in terms of rates and how are they going to try to adjust themselves given how the market is shifting on the yield side, which I think there's going to be a lot of pain coming, especially for those that remember the 2011, the pigs. Portugal, Italy, Ireland, Greece, and Spain. Ireland is not the same issue that it once was. So obviously we think that Portugal, Italy, Greece, and Spain will remain the key ones to watch. So now in the next segment, we're going to go deeper into Asia and things that are happening based on, mostly this one is going to be focused on China, India, South Korea, and Japan, the big four when we look at growth and or lack thereof in the Asian theater.